So next up we have a keynote presentation, Important Insights on Asset Allocation and Portfolio Construction from Katie Pettering at BlackRock. Over to you, Katie.
Thank you and good afternoon, everyone. I'm just going to pop this one down. Hopefully my other one's working. Let me know if not. Great to be here today. Thank you so much for having me. We have half an hour right after lunch, so hopefully I can keep you awake, not too sleepy. I will be walking you through our BlackRock Investment Institute's second half 2022 Global Investment Outlook. We have coined the theme for the outlook back to a volatile future, which will become more apparent why we've called it that shortly. But the spoiler alert is that we're in a fundamental regime change in our view. Can people see me? I'll move over here because I look a bit short over there. So we're in a fundamental regime change. We're moving away from, we've had a 30 or 40 year quite stable regime in growth and inflation. We're moving away from that now in our view. So portfolios will need to fundamentally change, and the way that we think about portfolios, portfolio construction for both tactical and strategic will need to change in this more volatile environment that we're moving towards. So we'll be stepping through our three key themes for 2022 that go along with our back to a volatile future framework, which are bracing for that volatility, living with inflation, and positioning for the net zero transition. So just as a summary, I guess the existing paradigm that we've been in, enjoying quite a stable period of growth and inflation volatility, is coming to an end. In our view, we're moving to a much more volatile period, away from that disinflationary regime, and the Fed and other central banks, in our view, will be a lot less powerful to impact inflation in this new environment. What that means for investments is that there's going to be inherently more volatility. So forecasting will be harder. Forecasting is already quite difficult. It will be even harder in this new regime with more volatility. It'll be harder to have confidence in future prices. So as a result of that, we will see higher risk premia across the board, equities and fixed income. So our first theme out of the three themes is to brace for that volatility. We'll see higher risk premia, and as a result, as investors, we need to become more nimble. We need to embrace that volatility and more granular in the way we construct our portfolios. And this is going to be a theme running through the presentation. The second theme is living with inflation. Now, there is a lot of talk from central banks, tough talk on inflation. Despite all that, given the significant trade-off between growth and inflation, in our view, central banks will ultimately need to learn to live with inflation. So we will end up in an environment where we have persistently higher inflation, but central banks oscillating between this quite difficult trade-off in this new volatile environment, where it's not as easy for them to control that environment by moving rates. As a result, we think there's going to be a persistently higher higher inflation and shorter, sharper economic cycles. In this environment, we do further cut risk tactically. So we've gone underweight equities. On a tactical basis, we stay strategically long-term. I'll be stepping through our tactical asset allocations a bit later on in the slide pack. And we've gone overweight credit in this environment on our view of the risk of low defaults in the shorter term. And the final theme is positioning for net zero. So there will be a bumpy transition. We acknowledge that, and that's part of this more volatile regime. We have already seen sustainable assets outperform non-sustainable assets. We think that there's further room to run. And so we do think a commodities can continue to have a role in the portfolio as well as sustainable assets. So positioning for net zero is an important theme in our 2022 half-2 outlook. So just stepping back a bit and working through all of those themes in a little bit more detail. Where are we? I think that everyone in this room knows, you don't need me to tell you that we're in a very difficult market this year. This chart plots bond returns and equity returns every year for the last 50 years. We're in this far left-hand corner here, the red dot, 2022. So far, year-to-date 2022, we're tracking as the worst year in the last 50 years. Historically unprecedented sell-off, and this is the backdrop for our back to a volatile future theme for our second half outlook. Continuing on this, the journey that we've been to get to the dot on the previous slide is this for bonds and equities. So global equities are the red, global bonds are the yellow. You would expect global equities to sell off in this environment. We've been through hawkish central banks, Russia invasion of Ukraine, the hawkish shift, China lockdowns, recession fears. All of that has unsettled markets. As a result, we've seen equities down. But you see bonds here. Usually, bonds would be the safe bet. And so our takeaway from this is that portfolios and portfolio allocations are fundamentally changing as we move into this new regime. And we need to be more nimble, and we need to rethink our asset allocation. We need to evolve the portfolio of the future. So let me frame this regime shift. As we say, this is the end of the Great Moderation. This period here, between these two lines, is what we call the Great, not we call, it was actually coined by two academics. Here we go, Jim Stock and Mark Watson. Bernanke and others have used the phrase as well. This period here of a moderation, so really steady, this is GDP growth and inflation, so really steady markets, a lot more volatile in the 1980s before that. And here you can see it's ticked up markedly. And so we see this as the start of this new regime, a regime change. This is a really pleasant period. It precipitated a bull run, decades-long bull run in both bonds and equities. And unfortunately, we're moving away from that period in our view and moving into a new, more volatile regime. This period, the Great Moderation, was really characterized by expanding production capacity. And in this environment, you had exuberance that drove overheating, and then you had sentiment collapsing, which drove recessions. And central banks could easily work with that. They could raise or lower rates, to deal with those environments. Now that we're in this new, more volatile environment, central banks can't impact the environment as much in this new regime. And so their policy is not going to be as effective as it has been in the past. So what we see is heightened macro volatility, higher risk premium in this more volatile environment. As I say, similar to the 1980s, hence getting back to the theme of our second half outlook, back to a volatile future. We've stolen a phrase from the 1980s there. And that's going to frame at least the next 6 months. So in this world, ultimately central banks, we think, will have to learn to live with inflation because the trade-off between growth and inflation is simply too high. As a result, we'll see this persistent inflation amid short, sharp economic cycles. Within this environment, as I say, we do stay pro-equities on a longer-term strategic basis, but short-term we have moved underweight. Why are we seeing the end of this period and how long is it here to stay, the new period? We do think it's going to be persistent and there is going to be pain until the Fed pivots. so we're in this world shaped by supply. So getting back to, if you think of earlier on in the year, there were supply constraints that was driving inflation. The important thing about that is that it's not overheating. So it's not excess demand, it's actually lack of supply. And that's a really important difference between the inflation in the 1970s and the inflation we have now. Central banks can't raise or lower rates to deal with this current inflation environment driven by supply rather than driven by excessive demand. So there's a big difference there. And in this world, we think that the production constraints are relatively sticky and here to stay. And think things like, since we've had the war in Ukraine, we've had the emergence of blocs, countries trying to shore up their energy security and their food security. So we've had deglobalization, and that's causing higher prices. And we think that is here to stay. We also have labour supply shortages, which are well known across the globe. The other thing that's causing that stickiness in production constraints is the transition, and that bumpy transition, which is causing a rise in pricing. We also have an environment of unprecedented leverage, which I'll step through in a couple of slides' time, and the politicization of everything. So now it's quite a nuanced environment, and we have central banks responding by talking tough on inflation. So they're responding to that politics of inflation rather than, and trying to talk tough on inflation rather than responding to the economics of inflation. And I'm going to go through that in a couple of slides' time. So the output of this is our first theme, bracing for volatility. So this chart has S&P 500 and GDP volatility back to 1970. And these grey shaded areas pick out the areas where volatility is medium or intermediate or high, not low. And so you can see every time GDP volatility spikes, so does market volatility. And this really underpins our view that we see this breakout in market volatility now that we've had macro volatility. So we're in this end of the Great Moderation into this new period of high volatility, rewiring of global supply chains, transition to net zero, and we're in this more volatile world. We think this regime won't be temporary, as I've just explained on the last slide. The implications for portfolios, as I said, in that bracing for volatility, because we are going to see higher risk premia. We don't think this is a buy the dip opportunity. The reason we think that is because policy will not step in quickly to alleviate the situation. The traditional 60-40 portfolio needs to be reevaluated. Traditional correlations just won't work anymore, and so we need to really reconsider our portfolios. We do think investors need to get a lot more granular and a lot more nimble. I'll talk through that a little bit later. And our market views are that is that we also have to change both the SAA and the TAA. Okay, just moving a little bit further on this bracing for volatility theme, our first theme in this new environment, the upshot of the higher risk premia, and I'll spend a little bit of time on this because it doesn't underpin our entire thesis for the second half. So this is where we think we were in the Great Moderation, and this is where we think we are now. You can see that this curve, the entire curve, has shifted up and to the right, and it's also lengthened. That's on purpose. So what this is saying is that central bank policy, this is inflation volatility and output volatility. And what this is saying up here is that basically there's a much starker trade-off for central banks when they're looking at the trade-off between growth and inflation than there was in the Great Moderation. So I've talked about it a bit already. Central banks won't have as much ability to influence the environment that they have in the past. At this extreme, you have central banks jacking up rates to fight inflation, and then you have a risk of recession. This will hurt equities. At this extreme, you have living with inflation, but then you have the risk of runaway inflation, higher term premium, bond prices fall. So the trade-off is a lot starker now than it was in the Great Moderation. Now, unfortunately, where we think we are here is 2022, the politics of inflation that I spoke about, where central banks are responding to the narrative of fighting inflation, and they're talking tough. So we think this is a 2022 story here. Where we think we're going to is 2023, the economics of inflation around about here. So it's going to be a little bit tough until the Fed pivots. It's going to be a lot more volatile as central banks really try and work out that balance between growth and inflation. And so far they haven't acknowledged that trade-off. And I'll describe a little bit later on. Until they do acknowledge that trade-off, we're not really going to get tactically more bullish on equities in our view. So first comes the pain. We don't recommend buying the dip because of that. We want to see central banks acknowledge that very stark trade-off, that new environment that they're in. Okay, now we come to our second theme, living with inflation. So just to set the scene again, we're in that world shaped by supply. It's not excess demand. We've had this major spending shift from services back to goods that still needs to normalise after the pandemic. Again, we don't have excessive demand, but we have these constraints that are rooted in the pandemic. And central banks have been jacking up rates to try and normalise inflation and try and get back to neutral. And the Fed is going even higher. The problem is now that rate hikes really can't do much to rein in inflation. And so central banks have this conundrum. They can stabilise output, they can stabilise inflation, but they can't stabilise both. So it's quite a conundrum. Ultimately, in our view, BlackRock Investment Institute, we feel that we see central banks and the Fed ultimately living with that higher inflation after some pain that we're looking to see further as this year progresses. We think that they need to learn to live with inflation because the cost to jobs, the cost to social cohesion and others is going to be too great. For now, they're boxed into responding to the politics of inflation that we've already talked about. So we'll see real economic pain. As I said originally, so this line, just to explain this chart, this is GDP before COVID. And then this is the trend line for GDP if we stayed on the pre-COVID trend. And obviously we've had a rocky road since then. The Fed initially slammed on the brakes to try and get production capacity to meet demand. We think they'll end up somewhere around here, somewhere in the middle, ultimately living with some level of inflation, say 3 is the new 2 or something like that. Okay. Further to living with inflation, another reason why we see that central banks will need to continue to live with higher inflation than they would otherwise like is because we have unprecedented debt levels at all parts of the community. So as a result, any increase in interest rates is going to have a lot more of an acute effect on governments, on individuals and on corporates. So it's not as easy for them to raise rates. During the pandemic, if you recall, central banks tried to alleviate the situation. As a result, there was a lot of spending and a lot of leverage taken out at that time at historically low rates. So jacking up rates at this time is going to have an outsized effect. So as a result, policy trade-offs are going to be a lot more difficult now. As I said, higher, shorter, sharper cycles. It's going to be very difficult for them to continue to raise rates, but we do see pain ahead until they pivot. And moving to our third theme, positioning for net zero. So we do think that moving to an environment, low carbon environment, is going to be a very bumpy ride ahead. We have seen green assets or sustainable assets outperform less sustainable assets to date. We think that has further to run. I'll show you that on the next slide. We don't think markets have fully priced in the transition. So we think there's a case for investors to invest in both sustainable assets, but also high carbon assets that have credible transition plans and to benefit from that green transition. And this is what the green transition looks like and where we think the pricing has further to run with green assets outperforming non-sustainable or non-green assets. All right, so moving on to our portfolio views. What does this mean for portfolios? We've set the scene. We're moving from a 30, 40-year great moderation theme into a new regime of higher volatility. Our themes are to brace for that volatility. We ultimately think central banks are going to live with inflation, and we need to acknowledge the transition, and there is a role for that for investors to use or to implement sustainable assets as well as fossil fuels in their portfolios going forward. So our view, BlackRock Investment Institute, is that we downgrade portfolio risk. So we're taking risk off the table because of that higher volatile environment that I've mentioned a number of times. So we have downweighted US and European equities in the short run. So tactical, 3 to 6 months is about the time frame. We have upgraded global credit. I'm going to walk through these in a bit more detail in the next slides. And we stay underweight global government bonds. We've been underweight global government bonds for some time now, and that's worked well for us. So let me step into those. All right, so the first one, this is tactical. I'll do strategic at the end. So as I said, tactical 3 to 6 month views. We have downgraded developed market equities to underweight. If you look at the left-hand side chart here, this plots CEO confidence against forward earnings per share. You can see usually they're quite correlated. At the moment, there's a big difference between the two. This is CPS estimates in the red and CEO confidence in the yellow, and it's fair to say, and we have been using this word internally, that CEO confidence has collapsed. We don't really like to use emotive terms, but I think from that chart it's fair to say that it has collapsed, and so we expect earnings to follow a similar path. On the right there, you can see S&P 500 plotted against 2-year US Treasuries. We use two-year US Treasuries because it basically is an indicator of what people think the Fed is going to do. And so you can see there that basically the market has priced in a hawkish Fed. That's what that chart is ultimately saying. So they've priced in a hawkish Fed, but they haven't yet priced in a collapse in earnings. And so we still think there's that, another shoe to drop, if you like, on equities. We're looking for, earnings, will be harder. There'll be headwinds for earnings to come, we expect. So we stay negative on equities in the next 3 to 6 months. Our second, looking to credit, tactical view is that we have gone overweight. This chart plots global fixed income assets going back to the 90s. You can see there the right-hand side, it's ticked up quite a lot. That's actually over 50%, so the majority of fixed income assets are yielding more than 4% for the first time in over a decade. This is 2010 here. So on a pricing basis, credit is offering great compensation for the risk, but also, as we mentioned, the policy response to the pandemic, allowed corporates to build up cash buffers. They also issued long-term debt at historically low rates. As a result, also remember, we don't think that there's going to be a deep recession to come. So therefore, we don't think with all of those inputs, we don't think that there will be higher defaults or a significant risk of default. So we think investors are compensated for risk in global credit at the moment. So hence, that's why we upgraded global credit for the next 3 to 6 months. We prefer to take risk in global credit than global equities at this point. So we think the Fed will pivot. It's just the timing of the pivot that's going to be important. And finally, we're sticking with our underweight to US Treasuries. We see term premia rising. We've been underweight US Treasuries for some time now, as I mentioned. They provide far less portfolio diversification than they used to. All you need to do is look at this pink line here. So this is US Treasury returns on equity down days. So US Treasuries down, US Treasuries down, US Treasuries up not much. Far less portfolio diversification, so it's hard to justify having US Treasuries in a portfolio at the moment. Hence our underweight continues. On emerging market debt, we are overweight emerging market local currency debt. This comes back to a valuation story as well. So it's yield and carry. There's an attractive combination there at the moment. We think that emerging market performance to date, you can see here, global emerging market versus global debt versus emerging market debt year to date. We think that emerging market debt has followed the path of developed market debt so far year to date. But we think that those higher yields are already pricing in emerging market debt, pricing in the monetary policy response in emerging markets. And we do think that investors are well compensated for the risk. So we have gone overweight local currency emerging market debt, not hard currency, because you still have the risk of US dollar there. Now, as I said, we firmly believe that in this new volatile environment, investors need to be more nimble and need to be prepared to be adaptable, not just on their tactical asset allocation, but also on their strategic asset allocation. So we've put this in. We haven't done this in the past, actually. This is new for this global update. These are our signposts to change. So this is the regimes or the signposts that we would look for to change our tactical views. And we think it's important that this framework is in place. You should all be putting this framework in place for your portfolio so you can be ready and be nimble to respond. The bottom line is that in this new regime with this being nimble, our signposts are, for example, for equities, we would expect a decisive dovish pivot by the Fed before we became more positive on equities on a tactical basis, or supply bottlenecks to ease significantly. Whereas to go more positive on global government bonds, we would expect a dovish pivot, but not as decisive as we would for equities. We would also expect inflation, we would need inflation expectations to be well anchored to go more positive on global government bonds. So just setting out this framework, and it's in the slide pack for you, to demonstrate our signposts and think about that ahead of time allows you to be more nimble. And I just want to spend some time on our strategic views. So this is how our strategic views have changed over time. These are our long-term strategic asset allocation. As I said, so we're short-term tactically underweight equities, but long-term we are strategically overweight. And it's basically in favour of equities over nominal bonds, and also we're in favour of inflation-linked bonds over a strategic horizon. This is the path of we've plotted our strategic asset or strategic preferences since August 2019. Over the long term, we do see yields rising further, especially in the long end, and we see inflation trending higher. And higher than markets expect in that medium term. And so, as we said, we do see central banks ultimately living with inflation and hiking eventually. And therefore, we see this as a boost for equities over the long run. Our SAA positions, as I said, need to be more flexible. We don't see this backup in yield as a revival of the 60-40 portfolio at all. We actually see more of a role in portfolios for private assets if you can. And for being more nimble and also using things like inflation-linked bonds if you can as well. So as I said, being more nimble and looking at strategic and tactical asset allocations as much as possible, watching out for those signposts. We've put in the deck as well our tactical granular views, which I won't go through in detail. There's equities and fixed income there for you. But just to wrap up, our theme for the second half is that we are moving into this fundamentally different regime. as investors, we need to think about it very, very differently. Central banks are going to have a tougher time influencing that regime with their policy. It just won't work like it has in the past. We think inflation will settle at a higher level. And we think there's a whole lot more volatility to come, hence we're underweight equities, overweight credit in the shorter term. So I'll leave it there. Thank you very much. And I think you've got the slide pack as well with all the granular details in there. So thank you very much for your attention.